Welcome back to Chip Stock Investor. Today we're covering two companies, Intuitive Surgical and Tesla. And we're going to start calling these our earnings rodeo. Nick, why are we covering these two companies today?
Yeah, so Intuitive Surgical, ticker ISRG, Tesla, TSLA. Neither of these companies are chip stocks. We'll call this, though, chip stocks plus. So earnings rodeo, chip stocks plus. Both of these companies are robotics businesses. We'll discuss why that is briefly, but they're prolific users of semiconductor technology. They've benefited a great deal from the advancement of chips and what they're capable of doing over the decades. So I think it's appropriate we start incorporating some of these businesses into Chip Stock Investor.
Yeah, makes total sense. Welcome. Okay, Nick, why don't we kick it off with the basic numbers?
Okay, so real quick rundown here on what Intuitive reported for the third quarter of 2022. Total revenue was $1.56 billion. That was an 11% increase compared to last year. Not bad. They reported an actual 9% decrease in sales from the actual placement of new Da Vinci systems. So Da Vinci is the name of the robot system that assists surgeons and surgical teams with surgeries. They actually had a decrease in sales from that, offset by a 20% increase in procedure growth. Intuitive has been reporting big increases in expenses this year. So that actually, this revenue growth actually resulted in a 14% decrease in earnings per share as a result of that. What stuck out to you about this earnings report as you were reviewing the numbers?
Well, I think the procedure growth of 20% is a big deal. In 2021, it was still affected by the pandemic, of course, and so a lot of people weren't getting their diagnostic tests, which led to fewer procedures. So that growth this year shows that people are actually getting the procedures done that they need.
Right. Yeah. And they did mention there are still some issues in some areas, like in China. They're still having lockdowns due to the pandemic. But right, 20% procedure growth is a big deal. And to your point, Intuitive's revenue is almost 60% now made up of instruments and accessories. So you have a background in, you're a nurse. You worked in an operating room for many years. What's the big deal about instrument and accessories?
Each procedure that is performed by the surgeon and the team requires many instruments. And even with a Da Vinci robot, it requires those same instruments. And so all of these instruments have a limited shelf life, and so they have to be repurchased.
Right. Yeah, that's notable, I think, for this company. Over time, these increases in procedures is going to be the primary growth factor for Intuitive going forward, given that almost 2/3 of revenue now are just instruments and accessories. So that's a good point. I think the other big thing that the market liked when it saw this report, because the stock did jump, was the company did an accelerated share repurchase program. So in lieu of a dividend, a lot of tech companies will repurchase stock. It boosts earnings per share for shareholders. They repurchased $1 billion worth of stock in that quarter alone. So if you're looking for like an equivalent dividend yield on an annualized basis, that's like a 5% dividend. They're not going to continue repurchasing stock at that rate every quarter, but this is a highly profitable business. It was a solid quarter overall. Not exactly a cheap stock, still like 60, 70 times earnings and trailing free cash flow. But let's jump to the ticker terminal here real quick. You can see here in 2021, Intuitive had a really big jump in free cash flow. And now scrolling down here, you can see free cash flow has dropped off all the way back to where it was in 2020, even a little bit below where it was 2020. Again, like I mentioned earlier, this is because the company is investing heavily in manufacturing. They're increasing their capacity as they expect big increases in sales in the coming years. Interestingly, management did say they'll see some of these expenses decrease or at least slow down in 2023. So I think we're going to see free cash flow make a rebound here. It's an expensive stock for a reason, in part because of this big decrease in profits this year, but the business is still in growth mode, which leads me to a question. You noted something about this new system. So DaVinci is Intuitive's primary robotic surgery system, but now they have this new thing called Ion. What do you know about Ion? Tell me about that.
Yeah, it's a robot that is designed to go into the lung and take a biopsy versus like having to do an open thoracic approach. So it's really cool technology. And the goal there is to be able to take those biopsies early for things like lung cancer suspicion. So it's really, really important technology.
Yeah. So this is pretty new. The pandemic actually slowed down the rollout of Ion. This will be a second growth driver for Intuitive in the coming years, but it's small right now. It's going to take some time. So in preparing for this segment, I thought it was interesting something you said about Intuitive Surgical, and to an extent, this is also something that Tesla is dealing with. But this is robotic-assisted surgery is still a very, very small portion of the medical field of healthcare overall. So you worked in an operating room for many years. Did you ever get to work with the DaVinci system?
No, I actually didn't. I worked in 2 different ambulatory surgery centers, and neither of them had the DaVinci system. And we did a lot of procedures that actually could be assisted by the DaVinci robot. So really, it's about adoption. Everybody has to be on board with this. The hospital system, the surgeons, the operating room staff, and everybody involved has to learn about the equipment, be trained on the equipment and the software. So it's a bit of a learning curve, and everybody needs to be on board to adopt it.
Yeah. And of course, a lot of hospitals, surgery centers, and so on. There's also the money factor as well. The pandemic has kind of stretched budgets a little bit thin. Overall, though, there's tons of room for growth out there. Intuitive is a slower growth business than it was in the past. But overall, this was a good report. Company's highly profitable, has tons of cash, almost $8 billion in cash sitting on the balance sheet. Solid robotics business. Okay, let's move on to earnings rodeo stock number 2, Tesla. Much more divisive company. Lots of polarized opinions on this. So before we jump into that, or before you leave, I'll just quick reminder, hit the bell, subscribe so you don't miss a video as we ramp up our coverage of third quarter earnings here.
Yeah, Tesla is divisive even in our relationship, isn't
it? Yeah, okay. So let's maybe start same place we did with Intuitive. Let's just talk about some high level numbers here with Tesla. A couple of real quick points. Record revenue, record operating profit, record free cash flow. Over the last 12 months, free cash flow was over $8.9 billion. Tesla continues to get more profitable. Operating margin was 17.2% in the third quarter of 2022. It was almost a 3 percentage point increase over last year. This is a textbook manufacturing play here. As Tesla continues to grow and expand, they get more profitable. They find new ways to increase efficiency. Lot of problems with the earnings, but overall, I think investors should be pleased with this progress. Tesla continues to deliver on the most important metrics, that being operating profit margin.
There were some issues here. As mentioned in the earnings call, the transportation of vehicles has become an ongoing issue, especially during the quarter. So normally at the end of the quarter, there's a mad rush to get all the vehicles out, and that's becoming more and more difficult. Transportation is more expensive. Elon Musk said there just weren't enough boats, not enough trains, not enough car carriers to support the wave of cars at the end of the quarter. So they're trying to smooth that out by getting cars out throughout the entire quarter more efficiently.
So let's maybe show the slide that Tesla themselves shared on the earnings call. You can see this wonky chart. The blue line is how they've been handling deliveries, and then they have this nice flat straight ideal delivery line here. Per usual, Elon is pretty dismissive of problems. I think with this case, we should take his word for this. And this is an inventory problem that is going to be taken care of by the end of this year, first quarter of 2023. Not that big of a deal. They'll figure out a way to smooth out the deliveries of vehicles throughout the whole quarter rather than trying to do it at the last month or the last couple of weeks of every quarter like they have been. They're just too big, and they've not been paying attention to inventory and delivery up until this point. And when you're cranking out a couple 100,000 cars every single quarter, you have to pay more attention to these types of things.
That makes sense.
Okay, there was another issue here with China as well. Elon said China is going through a bit of a recession right now, but again, was kind of dismissive of it, said that by and large, Tesla is recession resilient.
That's the word he used.
Yeah, okay. But like a couple days after the earnings report, Tesla reduces the cost of its vehicles in China.
He did mention that Tesla, he feels, is recession resilient. And he said that's because most people, when they're thinking about buying a new car right now, are at least thinking about purchasing an electric vehicle, which may lead them to Tesla.
Because it seems like inflation has peaked. Cost of goods that go into the manufacture of a car are coming down. So maybe this doesn't obliterate profit margins for Tesla, but it's worth keeping an eye on though, because I mean, let's face it, like half of the company's production and sales at this point are from China. Worth keeping an eye on for sure.
The other issue is the full self-driving.
Okay, so we have experience with this. Your opinion of full self-driving?
I feel like it's an overpromise, underdeliver situation.
You're probably right. That being said, we've discussed this a lot while using it.